For insight on whether developments in the banking sector might influence the Fed's next move, let's bring in Mimi Duff, Managing Director at GenTrust's, and Robert Dishner, Senior Portfolio Manager on the multi-sector fixed income team at Neuberger Berman. Yesterday, Mimi, we were hard-pressed to find any effect or any, once we saw that news over the weekend, you would have expected maybe something to happen in the 2-year or the 10-year. I guess, are we inured to this already, or we figure that's the last one?
Well, rates did sell off a little bit yesterday, but I don't think it had so much to do with the news over the weekend. I would say, I think on the margin, I would take the lack of effect in the markets as a positive, as we're seeing market function, which that's what the Fed and other regulators care about, smooth market function. So in that regard, I think it was taken as a positive.
So in terms of credit contraction, this is the third pretty big bank that maybe, I don't know if it services mom and pop operations, but are we seeing smaller banks pull in their lending horns at this point, Mimi? And can the Fed assume that if it does 25 today, can it assume there's another 50 or 100 in there that it doesn't have to do at this point that it was planning to do before?
Well, a couple things. Yellen has pointed out, and we subscribe to this too, that to the extent that there are credit tightening throughout banks, that would probably dampen the need to continue Fed rises. We do expect a rate rise tomorrow, to be clear. But the banks thus far haven't, to your point, been the mom and pops, but we do think that we're seeing stricter lending standards for all Americans. One indicator of that is the mortgage primary secondary spread. It's pretty wide right now. It's very wide. So above and beyond, say, the primary rates that Fannie Mae and Freddie Mac offer. So I do think that new loans being made now, given where rates are and given the credit situation, are a little bit more than a little bit tougher to come by than last year.
So, Robert, when the Titanic hit an iceberg, it's like there's only a little bit above the water. Is that what's happening now, or was it just a little piece of ice? Is it, or was there something? Is there something? Are we on the cusp of something much worse, or is this it after First Republic?
It's tough to say that this is just it, right? We're things act with a little bit of a lag, and we'll probably get a better feel for how things have tightened up come the summertime when credit lines come for renewal. For example, in the Dallas Fed survey, we saw one respondent note that their bank was unlikely to give them a new line, or if they did, it would be at substantially higher prices. So as we think about what that means for credit contraction into the summertime, it's still potentially early innings for some of that until we see the full effect. Now, we will get the senior loan officer survey out coming up here in the next week or so. We got it out of the European Central Bank today, which was a bit more mixed. And remember, things, while tightening, it's not exactly things were very loose a year or so ago. So we're going to have to sort of see the impact on the economy, and we expect to see that if it shows up really in first in these small businesses and then secondarily into the labor market if it happens.
Well, I guess is there duration risk? Is there a huge amount of that still left in the system that is going to, we're going up tomorrow, another 25 basis points. Commercial real estate. Are there people right now that do this for a living that are scouring the balance sheets of anyone they can find to find the next one of these vulnerable institutions? Is that happening right now? And do you expect more?
Absolutely. And I think, the scouring, of duration in banking has largely been done. And that's why people, other than maybe a few small banks here and there, largely feel like this was the last big problem put behind us. But your commercial real estate questions is a really good one. And a lot of the issues, people just hear that, they think commercial office in big cities. And the issue really is that most of the construction in commercial has really been Amazon warehouses. It's been manufacturing. So it's been a little bit less of the classic big Chicago, New York, LA, San Fran office buildings, and people are scouring that when is the debt coming due, what's the loan to value, and those type of things, and that's where we're likely to see, if there's problems, where that will come up. But then again, you look at some of the funds being raised for some of these real estate entities. They're all, it's the classic. You raise a lot of money for distress, and then there's no distress because there's too much money chasing it. So we're gonna have to see how it all plays out. But the commercial real estate market, Charlie Munger spoke about it over the weekend.
Yeah, he did.
May or may not be the big issue we all think it is.